Your cap rates are locked, your rent growth is capped, your financing window is closing. Here's what that means for your deals. Hey, Smarties, welcome back to Smart Real Estate. I'm Addy Saeed, and this week I'm flying solo. 2 weeks of market data combined into one episode because there's a lot to unpack. The Bank of Canada held its rate at 2.25%. The Fed signaled more hikes could still come, but U.S. inflation data just came in cooler than expected. Core CPI down to 2.6%. That's a contradiction, and it matters. Domestically, core inflation is below the Bank of Canada's target. Headline CPI at 2.8, down from 3.2% last month. Good news for borrowers, no mortgage renewal shock coming. But here's the tension. Rent inflation is stuck at 3.5%. Shelter price growth is the slowest across all CPI categories. Translation, borrowers get relief, investors get yield compression, rents stay low, and rents don't accelerate. Cap rates don't expand. That's the macro setup for this episode, and it shapes every story we're covering today. So core inflation numbers came in below target. CPI median at 1.9% and CPI trim at 1.8%, both undershooting the Bank of Canada's 2% midpoint. Sounds like good news. For borrowers, it is. For investors, it's more complicated. Here's the data. Headline CPI at 2.8%, down from 3.2% in May. Core measures, the ones that BOC watches or Bank of Canada watches, are even lower. Both below target. Energy prices are cooling. Gasoline down 10% month over month, but still up 20% year over year. But shelter, rent specifically, is stuck at 3.5%, unchanged month over month. The entire shelter category is up just 1.6% year over year. That's the lowest inflation of any CPI component, and that is the story. So what does 3.5% flat rent growth look like? Demand for housing is solid, but you're not getting pricing power. The economy is rebounding. Bank of Canada confirmed that this week. Household spending stayed resilient despite inflation. Household demand for apartment is real. But builders added capacity. Supply is catching up to demand. You get solid occupancy, stable rents. You don't get acceleration. Core inflation below target means Bank of Canada stays on hold through 2026. That's certain, but it also means no tailwind to rents, no cap rate expansion, and no operating leverage. So there's a bunch of key takeaways here. So Bank of Canada hold is confirmed. Rates staying low through 2026. Borrowers' relief is real. Rent growth is your constraint, not your tailwind. 3.5% capped, no acceleration in sight, and investors are shifting from growth arbitrage to cash flow harvesting. Stabilized yield beats development risk. Something worth watching. Next rent inflation print. Watch for acceleration signals. Also, Bank of Canada communication on timeline. Hold stays hold only if inflation cooperates. And an institutional bid on stabilized yield, capital is hunting rents that move up. So keep an eye out for that. So Minto Apartment REIT just announced it's going private. Crestpoint Real Estate and Minto Group are taking out at $18 per unit in cash, and the expected close is August 7th. Here's the critical data point. CMHC and major lenders had to consent to this deal. Leader consent isn't routine. It means that debt stack is material enough that lenders get approval rights on ownership changes. That's leverage. So why did lenders approve? Either the new owner can refinance the debt more cheaply, which means that the current stack is stressed, or lenders are just being cautious on multifamily right now. Probably a little bit of both. Institutional capital is consolidating multifamily, but debt markets are attaching conditions to it. That tells you something about portfolio stress and lender discipline. Your debt assumptions may be higher than what lenders are actually scrutinizing, and that changes your underwriting. A Toronto area townhouse developer just went into the Vic-Town project, 147 units, 82 sold, 65 remain unsold, no sales in 4 months. The developer ran out of capital. A fourth-ranking lender, FinDev, is now funding the restructuring, not because it wants to, because it has no choice. The top 3 lenders agreed to forbear, no altruism, because foreclosing destroys value faster than an orderly exit or an orderly sale. That's the debt market in 2026. Translation, forced supply hitting the Toronto market, bulk discount structures. Buyers get control and builder status preserved, but 65 units are moving. That is a market signal. Developer stress is real, absorption is slow, and carrying costs are killing builders. Senior lenders are prioritizing an orderly sale over acceleration. Junior capital is gridlocked with what moves supply now? For sales. So watch out for power of sale listings that are going to be entering the market, bulk discounts, and builder status resets. So every week we unpack the data. Access the full archives at learninvestmanage.com. Free for all smarties. Join the school community, SKOOL school community. Drop your question and let's talk strategy. So cap rates stopped compressing. For the past 2 quarters, we've watched multifamily yields compress. In Q2, they held flat across nearly every segment. That's stabilization, not compression, not expansion, equilibrium. So here's the regional read. For Toronto high-rise, a cap rate is between 3.85 to 4.75%, a nice 90 basis point spread from the best to the worst in the market. For Toronto high-rise B class, 4.15 to 5.15%, another 100 basis point spread. And Toronto new construction is between 4 and 4.75%. That's the tightest band of them all. Ottawa is a little bit different. High-rise is around 4.5% to 5%, and that's high-rise A, a tighter 50 basis point spread. Why? There's fewer deals and more defensive positioning. Lenders and investors are being cautious on the secondary markets, and the spread tells you everything. So cap rates stopped moving, and that's stabilization. Capital is comfortable at these levels. High-rise A, solid sponsors, minimum vacancy 3.85% in Toronto, makes sense to institutional capital. They're also putting larger down payments. High-rise B, weaker sponsors, mixed fundamentals, 5.15 is where lenders and investors say we need compensation for the risk. But stabilization also means no upside, no compression race. Lenders aren't loosening, they're picking winners and defending against losers. That 90 basis point spread between A and B is market discrimination in real time. So, CMHC MLI Select September 30th. Here's the clock. CMHC MLI financing has a hard deadline of September 30th, 2026. That's 7 weeks away from now. After that date, you can't underwrite new construction assuming CMHC insurance protections. You're back to conventional 75% loan to value and bank credit standards, tighter lending scrutiny, higher rates, and lower advance rates. If you got new construction deals in the pipeline, financing needs to be locked in before that deadline. The development market doesn't stop after September 30th. It slows, and that capital walks. So debt markets remain open but disciplined. Lenders are bidding aggressively to qualify assets. Multifamily, grocery anchor retail, well-located industrial are most sought after. Land loans remain tricky, particularly given underlying value constraints. So a translation, your stabilized market rent occupied multifamily asset with a solid sponsor finances at current cap rates. Your forward development on speculative terms, much harder. That's why Minto went private. That's why Wicktown went into CCAA. Capital is consolidating around certainty and lenders are enforcing it. So we got a couple of key takeaways here. So cap rates are locked at current levels, no compression, no expansion. Lender selectivity real and it's tightening. A quality assets gets financed. B quality assets get scrutinized heavily. MLI Select Deadline September 30th closes for new construction financing window. Lock in now or face conventional debt terms. Something worth watching. Post September 30th financing terms. What happens to the projects that didn't lock in? Watch out for those. Developer transaction velocity. Watch for acceleration into this deadline. An institutional bid on stabilized yield. Are the big players sitting on capital or are they just spread too thin? So this is a nice one. The Landlord and Tenant Board just opened up their books. Starting today, all final LTB orders issued between January and May 2026 are posted on the Ontario government's open data catalog. Historical orders back to 2021 will be added in phases. Current orders will be posted monthly. Why does this matter? Because you've been flying blind on tenant risk. Now you'll be able to see what actually works in front of an adjudicator, what ground stakes, what arguments fail, what damage award looks like, and that's investor intelligence. This is an operational relief. Better information, smarter underwriting, and real-time data on landlord and tenant board trends is market intelligence. It also is a signal about Ontario's investment environment. The system is getting more professional, more transparent, and more predictable. That matters for disciplined capital. You can model tenant risk more accurately and build it into your deal economics. So here's what we have covered today, and here's what it means. Theme number 1, stabilization. Cap rates are locked. Rent growth is capped at 3.5%. Rates aren't moving, that's certainty, but it's not bullish. It's equilibrium. No operating leverage, no compression raise. That challenges how you value assets today. Theme number 2, lender sensitivity. Minto just went private because public equity got too risky in this environment. Wicktown went into CCAA because carry costs destroyed value. Institutional capital is consolidating certainty. Lenders are picking winners. That's discipline, and it's getting sharper. And theme number 3, window closing. The MLI Select deadline is real. September 30th is a hard stop. If you've got new construction deals financing, you need to lock it in now. This window doesn't stay open. A couple of key takeaways we got for you. Your stabilized market rent asset financed at current cap rate. Don't expect compression or expansion. Development gets harder. Lenders are tightening. MLI Select deadline approaching. If you're building new, move capital now. Rent growth is constrained. Operating leverage is limited. Focus on yield quality, not growth arbitrage. Smarties, that's the episode. Cap rates are ceilings, not opportunity. For the full breakdown on Ontario multifamily regional cap rates, developer stress, and what lender sensitivity means to your next deal, head over to learninvestmanage.com. Full access, free for all smarties. Sign up to join our school community and let's talk strategy. Addy Saeed is a licensed real estate broker of the Remax Gold Realty Inc., RICO license 4735346, founder and general manager of Westcliff Living and an OSC registered dealing rep. The host may reference companies or entities in which he holds ownership or financial interest, including Westcliff Asset Management, Westcliff Living, Olympus Properties Group, and Finalize LLP. Listeners should be aware of these relationships when evaluating any commentary in this episode. The podcast is for informational and educational purposes only. Nothing in this episode constitutes financial, legal, mortgage, or investment advice. Always conduct your own due diligence and consult a qualified professional before making any investment decisions. Past performance is not indicative of future results.